Today is the second webinar that we will have, and the first dedicated to the SMEs. The webinar is organized in the framework of the Cluster Act project and is tackling the role and importance of angel investor and venture capital for SMEs. We will have with us Paolo Anselmo from IBAN and also Giovanni Fusaro from AIFI, and that I'm welcoming and thanking for being with us. I would just provide you just a brief information in relation to the webinars that we will have in the first stage the presentation of the speakers, and later we will have time to review any question if you have that you can pose with the application that that you can find in the GoToWebinar tool. So actually I'm welcoming all of you here, and I'm just reminding you that the webinars are organized in the framework of Cluster Act, an ASME funded project that is dedicated to support the investment in the maritime sector in the Mediterranean. So good afternoon, Paolo. We can hear you. And now I will just give you the stage to proceed with the webinar.
Okay. Good afternoon to everybody. My name is Paolo Anselmo.
Just a moment.
Okay.
Just a moment, Paolo. I will just make you officially, and now you can proceed. Sorry for interruption.
It's okay, my screen, huh?
Yes, we can see your screen, yes. Okay. And also your webcam.
Okay, so I go to full screen. Okay. So, ladies and gentlemen, good afternoon. Okay. Ladies and gentlemen, good afternoon. My name is Paolo Anselmo, and I am the Italian Business Angel Network Association President. This webinar will be focused on angel investing, especially regarding the role and the importance of business angel toward small and medium-sized enterprise access to financial resources. A very important challenge in Europe and worldwide. A significant portion of European SMEs still experience barrier in access to finance. This proportion varies strongly from country to country. In addition, development in financial market conditions have been geographically unbalanced, and several countries are stuck in low growth trap. Reason can be both demand and supply side driven. There is a high degree of uncertainty as regards the economic development, with a negative impact on investment behavior. More SMEs rely on self-financing for their growth. A significant portion of SMEs do not apply for bank loan because they have access to sufficient internal funds. Another explanation could be that they are more risk adverse and exchange stronger growth by slower growth with lower leverage. There are several possibilities of financing a company: equity or debt. We can summarize 8 bullet points: own founder money, love money coming from family, friends, or food, bank loan with or without guarantee, public grant at local or national level, public venture capital or corporate venturing, the so-called larger equity, mezzanine finance, public share issue, for example, IPO, initial public offering, and informal investment coming from business angel, the so-called small equity provider. Business angels are private individuals investing part of their personal asset in businesses and contributing with their managerial skill and experience to the company growth. Some remark on the range of financial intermediaries. The source is the European Investment Fund, the European Investment Bank Group specialist provider of risk financing for entrepreneurship and innovation across Europe. Pay attention to the angel segment. Please note that angels are active in the phase where the risk is higher. Pre-seed and seed capital concern capital required for the purpose of financing project upstream of product or service marketing. Seed capital is often essential for high-tech projects in order to allow businesses to study, research, and develop prototype of product that later come to constitute their core business. As we pay attention to the equity provider, we can start with pro. No cost of interest and no fixed repayment schedule. A stronger financial position, a reduced financial pressure, the access to professional network and coaching. Moving to constraint, we highlight loss of management control, as we have more shareholder in action, a request for a strong financial discipline, the investor influence on management and strategic decision, an exit route for investor to be prepared since the beginning of a due diligence process. Business angels represent an important class of private equity investor, high net worth individual, usually with entrepreneurial and managerial experience. Angels tend to invest their own money, either individually or in formal or informal syndicate. Businesses are not publicly traded. In a recent European Commission survey among European angels, the large majority of respondents were male, 89%, and the average age was 55 years. In Central and Eastern Europe, angels tend to be younger, average age of 43 years, and the share of male angels is larger. The average period of respondent investment experience as an angel was 7.5 years, with large difference by country. 98% hold at least a bachelor degree or equivalent, and the majority, 87%, have experience in senior management. Angels differ from VC fund. VC fund primarily invests third-party resources. VC fund invests in scale-up companies. Angel-backed companies are typically startups. Angel transaction costs are relatively lower. Smaller scale investment performed in local market. Angels tend to be very hands-on investor, providing also mentoring, business advice, and asset network. They always play a central role in the startup ecosystem, in particular for innovative firms. Angels have a positive impact on the firm invests in. The success of investees seems to be strongly based on the support beyond financing of the angel that the angel provide. Mentoring and coach, I said before, it's very important. Moreover, angels are relatively resilient to changing market cycle. Angel investment tended to increase during and after the economic crisis, as VC fund migrated to less risky investment. Co-investment are more and more relevant. An increasing majority of angels co-invest with other early-stage investors in order to diversify risk. Sourcing channels like crowdfunding platforms are also used by angels as tools to find investment opportunities. However, this seems to be more popular among younger and less experienced angels. Crowdfunding platforms are less attractive for experienced angels. Angel support is relevant, but it is difficult to measure the size of a business angel community. Angels often stay anonymous, and the details of their investment are rarely disclosed. Virgin angels are not so active. Serial entrepreneurs invest frequently, but do not consider themselves as being part of the angel community. What about the most important investment sector? ICT and other technological sector continue to be by far the most attractive target sector for angel deals. Within the tech sector, fintech and enterprise software receive most investment. But in the last year, we think that it is increasing the interest toward other sectors like food, industry device, medtech, and social media. Anyway, please note that 26% of respondents indicate that they have no specific sector focus, but mainly look at the team, the idea, the product, or the market. Anyway, the second focus also contribute to the formation of a specific investor community. With regard to the investee company development stage, pre-seed 36% and seed 62% investment are more popular, while 40% of the angels also go beyond this stage. Concerning biggest challenge of angel activity, most important topics are number of high-quality entrepreneurs, high investee company valuation, identify good investment opportunity, exit environment. Market volatility and Brexit are not so relevant. The term angel comes from the practice in the early 900th century of wealthy businessmen investing in Broadway theatrical production in US. No reference to the Christian religious context. IBAN Association conducts every year an annual survey data collection survey, which is with an online questionnaire on investment made the previous year. Our survey involved IBAN member, indirect member belonging to club or business angel network associated with IBAN, and other investor selected by the association. Summarizing, the most relevant bullet points are: angels are always equity investors. The investment size is between 10,000 and 100,000 euro. Aim is share managerial skill, no sector preference, to act as a local investor, seeking profit but also adventure challenge, investment below 15% of wealth. What about the business management involvement? If it is present, we are active angel. If no, we are passive angel, generally member of a syndication. Since the last free survey, we confirm the strengthening of operation made by business angel syndication. This is due mainly to a bigger capital gathering that give a possibility to invest in larger startups and in more industry, together with a lower risk. Moreover, angel capital is the first outside capital a startup company receives that is not provided by founder, friends, family, or fools. It is difficult to explain and predict entrepreneurship by approaching the question from an investor point of view. So we refer to Marco Virtanen paper, The Role of Different Theories in Explaining Entrepreneurship. Virtanen is a professor of the Helsinki School of Economics and Business Administration. Entrepreneurship is the dynamic process of creating incremental wealth. Concerning the angel investment criteria, investors pay attention to the atmosphere of trust between individuals involved, sustainable business plan, strong management team, market knowledge of a founder, prototype, product, service, readiness, company high growth and scalability, an existing objective pre-money valuation, the availability of exit route, a future capital gain, and existing fiscal incentive. Due to the investment criteria, we are facing an existing paradox. 3 questions are on the negotiation table. 1. Are entrepreneurs aware of investor aspiration and expectation? We refer to the foreseen capital gain. Are entrepreneurs ready to receive equity finance? We refer to the founder investment readiness experience. Are entrepreneur proposal, ideas, proof of concept really innovative for investor? We refer to IP, intellectual property, state of the art, and the existing competitor SWOT analysis. 4 types of issue belong to the company founder trying to raise equity. Equity aversion. Equity aversion is the cultural reluctance when it comes to opening their company to outsider. Asymmetry of information. Difficulties in presenting themselves or their business plan in a way that accommodates the priority and the management required of the equity supplier. Project investment readiness. Certain equity and risk capital tool, and we pay attention to the tool later, are not adapted to the need of the whole business model at all stages of their development. Difficulties in reckoning with the legal administrative requirement of risk capital player, for example, corporate governance rules, and the importance of regular economic and financial reporting to investors. Regarding the portfolio company management, angels are a blend of the following items. Staying involved in the company backed, for example, as board member, we refer to a high sense of usefulness. Give back their experience, to act as a coach or as a mentor. The affection to open mind start-upper, step in during your crisis or period, assist in raising additional money from angel during the crowdfunding campaign, coming from venture capital player. Return on investment thanks to the exit. Please always remember that angel anyway are part-time investors. Moving to the angel asset allocation strategy, we can underline as best practices 5 to 10% of the net worth invested, 8 to 15 investment. Sector is a mixture of high-tech, low-tech, no-tech. Always a variety of involvement, lead investor, board member, advisor, passive role. As final remark, most of the return on investment come only from 1 or 2 of the 10 company angel backed. These are conservative portfolio considerations. In a paper published by the Center of Venture Research, based on the survey of 150 angels, 50% of these angels had 15% of their net worth invested in angel deal, but a surprising 10% of angels had as much as 50% of their net worth in angel investment. Also, the statistics available on high-tech versus low no-tech are interesting. Less than 1/3 of high-end C500 companies are typically high-tech companies, but only about 20% of the members of a young entrepreneur organization, 3,500 members in North America, are high-tech companies. And according to Fortune magazine, less than 0.5% of new companies are considered high-tech companies. Concerning the exit strategy, VC exit in 3-5 years. Angel invest earlier and expect to exit in 5 to 7 years. A balanced angel portfolio contains 10 companies. Consequently, angel should invest in 2-3 companies per year. Action to do for an angel: build to 10 company portfolio gradually. A portfolio of company in all stages of development. Good balance for investment time and management commitment. A mistake to avoid is to invest in 10 companies in only 1 year. This means a tremendous amount of work in this year. All companies are generally at the same stage. After a few years, engagement with the company quickly decreases. Angels who make all investment out of the outset don't have a chance to learn from their mistake. Investment are the final step of a long run. A business relationship between entrepreneur and investor are managed through different documents. We refer to the Angel Toolkit. Elevator pitch is a 2-minute verbal summary. Index include product, opportunity, differentiation toward competitor. The aim is to attract interest, not closing the deal. Executive summary is 2-4 pages written summary with a very good balanced presentation. The aim is to attract interest, not to closing. PowerPoint deck is 8 to 10 minutes verbal presentation that cover the whole business plan index. The aim is to find serious investor and to start negotiation. Business plan is the right is the most important document, 20 to 50 pages, and it is finalized to manage and to close the due diligence and to close the deal. Critical issue that can stop a positive closing of the deal during the due diligence activity. Step 1. First meeting and initial screening. Entrepreneur expectation of startup value proposition are inconsistent. Company limited growth potential is low. Lack of affinity between founder and investor. Step 2. Business plan analysis. Risible market projection. Lack of data. Weak management team. Step 3 concerns the involvement and the commitment of external advisor. Critical issue concern letter of intent, not acceptable valuation, no acceptance of exclusivity terms, return on investment too low, technical, legal, and financial due diligence, poor intellectual property, generic financial planning, high cash flow burn rate. The evaluation pre and post money, that means the percentage of a company given to an investor. Final step, shareholder agreement. These are all the critical issues. How to manage the deal? The focus on syndication role. Investing as a solo angel is very difficult. Investment process is time-consuming and concern three activities. Deal sourcing. Deals are hard to find. Reading business plan. Remember the toolkit description and all the tools which are included. Due diligence. Due diligence is more and more difficult. It's difficult to have since the beginning a vertical experience. May require using outside expert. The outside expert support is expensive. Angel group and network change that dynamic by increasing deal flow, making due diligence more efficient, increasing the number of angels who are willing to participate, permitting entrepreneur to present to larger group rather than seek out angel on one-by-one basis. Furthermore, angel organization have standardized the investment process and attracted VC as syndication partner. The growth of angel investment group are gradually created the informal risk capital industry. All access to finance problem had found it the best solution? No. The funding gap is always existing and involved company requiring finance range between $500,000 to $1 million, as very few angel deal done above $500,000, very few VC deal done below $1 million. Moving to our conclusion. What about angel and VC pro and constraint? Angel, difficult to find. Angel request a strong personal involvement. Angel have a limited amount to invest. But investment decisions are quick and less formal. Syndication are more and more usual. Exit route less in focus. Important, but is less in focus. VC, easy to find via directory or thanks to AIFI cooperation. Your request is only one among many hundred of VC received. Can provide large investment, for example, via syndication. Heavy formal due diligence and investment process. Exit route is very important. What about our association? Our expertise include recruiting angel and facilitate the setting up of business angel network and club. We move to ready to invest activities. Organizing investment forum between investor and companies searching for capital. Organizing business angel academy training event. Stimulating the exchange of experience among business angel network and encouraging best practice. Scouting and helping the financing of startups, increasing the source of financing for unlisted SMEs and startups. We are active since 1999, and we represent the Italian community of informal venture capital investor in our country, in Italy.
Thank you, Paolo. Thank you for your contribution. We will come later with the questions. Now I just switch to Giovanni Fusaro and just moving with just checking. Okay, now we can see you, Giovanni, we can see your screen and we can see also you. So just please welcome and go on with your presentation. Thank you very much.
Thank you very much. Just a second. All right. So good afternoon to everyone. I'm Giovanni Fusaro and I am part of the Study and Research Office of AIFI, the Italian Private Equity Venture Capital and Private Debt Association that institutionally represents and promotes the activity of the industry in Italy and abroad. With the next slides, I will try to present the venture capital activity and to give a snapshot of the Italian venture capital market. First of all, I would like to start from some definitions because venture capital can be considered as a part of private equity. Private equity, using the Invest Europe definition, is a form of professional investments that involves taking an ownership interest, so equity, in a company and holding it private hands, as opposed to a public stock exchange. As I said before, so venture capital is a private equity investment that is focused on startup companies. VC backs entrepreneurs who have bright ideas but need finance and expertise to get their companies off the ground and grow. I would like to give you a snapshot on venture capital main activities. The main activities of this kind of asset class are fundraising, investment, and divestment. This is one of the main differences between venture capital players and business angels. Venture capital players manage funds coming from institutional investors, such as pension fund, insurance companies, government agencies, fund of funds, and so on. And they have to manage those funds, investing in startups in order to obtain a capital gain that will be distributed back to the institutional investors. So the first activity, as I said before, is fundraising. General partners, closed-end fund manager that manages VC fund, raise funds from limited partners, And then they start their second activity, which is the investment phase. They invest those funds into startup or scale up, and they try to create value supporting the portfolio companies, as I said before, in order to obtain a capital gain. In the end, the returns will be distributed to the limited partners through the after the divestment phase. The VC funds and the general partners distribute the returns back to the LPs. Talking about general partners managing VC funds, they are usually promoted by private companies. They are managed by private people, and they are managing. They manage 10 years venture capital funds. In Italy, the average size is from 80 to 100 million euros, while in the rest of Europe the size is bigger. The objective is to create value in portfolio companies with the aim of obtain a capital gain in the divestment moment. Moving to the next slide, talking about investment stages of venture capital, we can see in particular seed, startup, and later stage venture capital, and a part of expansion with particular reference to tech growth. Moving to the seed capital, startup financing, and later stage venture capital, I'm gonna give you some definitions in order to better understand when this kind of investments acts. Seed capital can be defined as the funding provided to companies to test ideas, complete research, and create prototypes. So the startups is not selling anything and needs to validate the business idea. Startup financing is can be defined as a funding provided to companies with fully developed products and or services with the aim of starting sales or production or distribution. While later stage venture capital can be defined as funding provided to companies often already backed by VC players to scaling up the business. But I think that using some information coming from the market, coming from my experience, it could be very interesting to understand what venture capitalists look for. First of all, a solid management team with high experience and expertise in the sector. A unique and innovative product or service, a defendable business in the medium-term horizon, but also large market size and opportunity, and a clear strategy for the market opportunity. Then the business should have a strong plan to become profitable, because we are talking about startups, and if in the first years the business usually is not profitable, but it must have high growth rates in order to obtain high value at exit, because as I said before, the main objective of a VC fund is to obtain a capital gain. Then I would like to give you some information on the venture capital investment selection. the difference between, as Paolo said before, a business angel and a VC fund is that a VC fund usually receives hundreds, even 1,000 business plan per year. On average, on 100 business plan received, after the first screening, the VC fund usually select 50 projects. Then after an in-depth analysis, the selection refers to 20 projects. Then after a formal due diligence, the projects are 10. And in the end, all this process goes to 2 or 3 investments. So only the 2 or 3% of 100 business plan received goes to investments. How venture capital funds support the startups in order to create value? Using a report published by Bank of Italy and AIFI, the main activities in which venture capital funds are active to support startups are the development of international activities, the support on financial issues, the development of business strategy, and also an improvement of the relationship with other financial players. So in those areas, usually VC players are very active, and so they provide money and funds, but also support in this kind of areas. As I said before, the last activity of this of the venture capital process is the divestment. So after the value creation process, there can be 2 different ends. One, a negative one with the failure. In this case, we have the so-called write-off. So the total write-down of the company's value to 0, with the consequent exit from the company or the share owned by the venture capital player, or success. In this case, we have 4 different routes of exit, such as the initial public offering or the trade sale. The trade sale when the target company is sold to a corporate investor. A new round of financing when another VC funds invest in the startup to develop a new phase of development. And then the last one is the buyback, when the entrepreneur buys the shares owned by the VC fund. Venture capital on a general level has an economic impact. In particular, looking at Italy, using a report and an analysis made by Università Cattaneo LIUC from Castellanza, we can see that for each million euro invested in venture capital is possible to attribute 1.5 million invested in fixed assets, about 1 million euro of added value created, and 12 new jobs created. So venture capital has an economic impact and foster innovation and economic growth. Moving to the last slides, I try to give you a snapshot of Italian and European venture capital markets. In particular, as you can see, Italy still lags behind the other main venture capital markets in Europe. In particular, I refer to the French, the German, and the UK markets that are characterized by a number of VC players higher than Italy. In particular, on average, there are more than 100 VC players in each market. And the total amount invested in 2018 in France was 1.5 billion, in Germany 1.5 billion as well, while in the UK 1.9 million euros. As I said, Italy still lags behind because in Italy we have only about 20-25 venture capital players, and in 2018 the total amount invested was equal to 300 million euros. And considering also co-investors, the total amount was equal to 500 million euros. So in Italy, the market is smaller than the other country, but is developing well, and we hope that in the future it could be very close to the other ones. In the end, I would like to give you some information of our association. AIFI, as I said before, is the Italian Private Equity, Venture Capital and Private Debt Association that was founded in 1986. That is recognized on an international level for its activity of institutional representation and promotion of this industry. Among our members, we have venture capital, private equity, and private debt players, but also professional active in those industries. On general level, we have 130 full members and 130 associate members. I think I can leave the floor to Carlo. I have finished my presentation, so thank you very much.
Okay, good afternoon again. Thank you, Giovanni, for your contribution. I think it was really too interesting.